Mortgage rates are now at the highest level of the year and could still climb. The average rate on the popular 30-year fixed mortgage crossed over 7% on April 1st, according to Mortgage News Daily, and it just keeps going. It now sits right around 7.5%, the highest level since mid-November of last year. Rates hit their highest level in a few decades last October, causing home sales to grind to a halt. Builders jumped to buy down rates for their customers and managed to do better than existing home sellers. Rates then fell through mid-January to the mid-6% range and held there into February, causing a surge in home sales. But then they began to rise again. And this is something we can see backed up by the government data. The Fed tracks all of this, and as we can see here in this time in the last we'll do say the last decade or so. We can see that interest rates got quite low in 2021, but they've had quite the large spike here in the last few months, with the most recent data being April 18th, 7.1%, which is pretty close to what is being, this is reported by Freddie Mac, and that's quite close to what's being reported here by Mortgage News Daily. And this is pretty unfortunate for buyers because homes are getting more and more expensive, and this should theoretically be unfortunate for sellers as well because people might be less likely to buy. But weirdly enough, we're not actually seeing this. Even though prices are high, the willingness to purchase seems to be going up as well. As you can see here, mortgage applications increase in the latest MBA weekly survey. So mortgage applications increased from 3.3% from a week earlier, according to data from the Mortgage Bankers Association, MBA, weekly mortgage application survey for the week ending in April 12th, 2024. The Market Composite Index, a measure of mortgage loan application volume, increased 3.3% on seasonally adjusted basis from 1 week earlier. On an unadjusted basis, the index increased 4% compared with the previous week. And then it just gives some other refinancing information, so we'll skip down here. This is a quote: rates increased for the second consecutive week, driven by incoming data indicating that the economy remains strong and inflation is proving tougher to bring down. Mortgage rates increased across the board, with a 30-year fixed rate at 7.13%, reaching the highest level since December of 2023, said Joel Kahn, MBA's vice president and deputy chief economist. Despite these higher rates, application activity picked up, possibly as some borrowers decide to act in case rates continue to rise. Purchase applications drove most of the increase, but remain at low levels of around 10% behind last year's pace. Refinance application increased very slightly, driven by a 3% gain in conventional applications. So the core concern from buyers is that the Fed is going to increase interest rates again due to the fact that inflation is not coming down, and they will then have no option but to lock in a home purchase at a higher interest rate than what is currently already happening. And this concern is not without legitimacy. As you can see, this was back April 10th, so this was a couple of weeks ago. The Fed is determined not to reduce interest rates too soon, experts say, a mistake that the central bank has made in the past. The Federal Reserve is in no rush to lower its benchmark rate. Earlier expectations that the central bank was planning multiple cuts before the end of the year seem less likely. On the heels of Friday's strong jobs report, Wednesday's consumer price index increased at a faster than expected pace in March. Both suggest that inflation is staying stubbornly higher, which experts say is likely to keep the Fed on the sidelines. People want to pay the lowest possible price for their houses, which totally makes sense, but it's suddenly seeming like the lowest possible price they're going to get is right now, because if inflation continues to go up, there is a legitimate possibility that the Fed will continue to increase its benchmark rate, and that will make houses even more expensive than they already are. Imagine you're a couple that's planning to buy a house. You've got money saved up, and you're basically just waiting for the Fed to cut interest rates in June so that you can lock in at a lower interest rate. But then the Fed not only doesn't cut interest rates, but the new inflation report comes out and it's higher than normal. So suddenly there's a possibility that maybe the Fed is going to increase interest rates. Well, now you want to buy right now to lock in that lower interest rate. There are lots of people or couples or families that are in that boat right now where they were going to buy a house as soon as interest rates dropped, but now that they're not going to, they're going to jump on and buy a house right now, which will artificially and in the short term increase demand. And I say in the short term because I believe that this is a very brief spike in demand, and that's basically because housing remains very unaffordable and supply continues to, on average, go down. As you can see here, this is from Realtor, so this is absolutely just one website, but according to Realtor.com, the number of active listings that they had in July of 2016 was 1.4 million, and the number of active listings they have right now is about 700,000. That's a 50% drop over the last 7 years. Now, I get that this is just from one website, so if you have another source that shows shows like the total of all listings in the United States, please absolutely drop that in the comments. I would love another source. So because this supply is going down, the median sales price of a home is going up. If we jump here to 2016, which is what this covered as well, then we can see the median sales price of a home absolutely skyrocketing here in the last little bit. And not only is it skyrocketing here in the past few years, but as we can see when we look at the median personal income, it is basically 10 times what the median personal income is right now for an average house. This is one of the largest median income to home price disparities we've seen at pretty much any point in history. And this is a problem because it indicates a general unaffordability of buying houses for the middle and lower class. Now, whenever something like this is brought up, a lot of people will always ask, well, should I buy a house now then? And the answer is always, if you can afford it. And people in the comments always get upset when I say that. They say that they will never be able to afford a house, or it continues to get more and more unaffordable every day, so how can they afford to wait? And that is absolutely true, and I sympathize with that. I'm in the same boat. I can't afford a house either. But the one thing that's worse than being unable to afford a house is being unable to afford a house and then buying it anyway and setting yourself up for financial ruin because you can't afford your mortgage payments. The solution to a bad situation is not to make bad decisions as well. It's electing people that will bring about change and help fix the actual problem. The situation sucks. And I get it, and I'm sorry, but please don't make a bad situation worse by endangering your financial future and the financial future of any family members or dependents you might have by buying a house when you simply can't afford it. There is a possibility that this will be a brief spike, but whether interest rates continue to go up or down, I promise to make a video and keep you updated. Thanks for watching.